Good afternoon. Thank you for joining us for the 2022 Wealth Management Forum. My name is Jason Jackman, President and Chief Investment Officer of Johnson Investment Counsel. There's certainly a lot to talk about today, and we know you have questions about the volatility in the markets that we've seen so far this year, various aspects of the economy, and policy coming out of Washington, D.C. Over the next hour, you'll hear from Charles Reinhardt and Brandon Zurich on the markets and the economy. Then you'll hear from President of our trust company, Michael Barnes, before we turn it over to a talented panel of portfolio managers and attorneys, Scott Wyckoff, Mary Burns, Tony Cure, and Laura Mattern, to discuss wealth management and planning topics for the coming year. Before we get to the heart of the presentation, though, I'll make just a few brief comments on the firm. If you logged in a few minutes early, you saw some slides scrolling through with highlights from the past year. We continue to receive regional and national recognition for our investment management, service offering, and culture. In addition, thanks to your generosity and confidence, more and more of you are referring your family, friends, and colleagues. Our assets under management have now surpassed $18 billion across our offices. We've witnessed meaningful growth in our family office, trust company, and asset management divisions. And each of our offices, Cincinnati, Dayton, Columbus, Cleveland, and Detroit, are also growing. This means we are helping more families and institutions than at any other point in our history. It means we're able to invest in our service offering and expertise to provide truly comprehensive wealth management. It means we have more talented and credentialed employees than ever before, each committed to delivering on our mission. That mission of providing financial peace of mind to our clients throughout life's journey. Every season, every stage, every event in life, we are committed to being there with both counsel and care. Our full team of portfolio managers, research analysts, attorneys, trust officers, planners, and support personnel are here for you and your family. Each team member dedicated to providing comprehensive wealth management and delivering on your goals and objectives. Thank you for sharing your life's journey with us and allowing us to serve you. Thank you also for joining us today. I'll now turn it over to our talented team for an hour full of information and perspective. So let me kick it over to Brandon to cover the most asked question in the registration process, inflation.
Thanks, Jason. I can't remember a time when investors were focused on one singular theme quite like they are today with the outlook for inflation. In fact, we gave you all the opportunity to mention those concerns that you have as we enter 2022, and not surprisingly, over 60% of responses directly referenced inflation. I think that's certainly understandable, as there's growing anxiety around the impact that inflation can have, not just on your day-to-day cost of living, but on hard-earned retirement portfolios and investment portfolios. So our goal here today is to provide a simple and straightforward framework to help you better understand what's driving inflation, offer a roadmap as to where we believe the economy and inflation are likely to head, and some remarks from Charles will certainly shed light on the types of things we're doing in portfolios to prepare for that outlook. That being said, let's jump right in. And I want to take a step back to March of 2020. So I know that can probably conjure up some unpleasant memories, but I think it's important to start all the way back at the beginning of COVID to understand how we got to where we're at today. If we think about it, we voluntarily shut down big portions of the economy. In fact, GDP fell by 30%, 20 million people were without reliable employment, and policymakers, they felt compelled to step in and intervene, and intervene they did in a pretty meaningful way. So this chart that's up on your screens, if you focus on the right side, the gray bar, that's an attempt to quantify the cumulative federal spending aimed at various forms of COVID relief. So everything from extended unemployment benefits to direct checks in the hands of consumers to forgivable loans for small businesses. Very meaningful stimulus effort aimed at helping the economy recover. You know, the Fed, they weren't going to be outdone by their counterparts in Washington either, and you know, they joined the stimulus effort as well. If you remember, the Fed cut interest rates very quickly down to zero and also reinstituted quantitative easing. So as of the end of last year, the Fed has purchased a total of $4.1 trillion in assets. And if we combine these two factors together, federal spending and monetary stimulus, we're just shy of $9 total trillion in spending. And here's the important point that I hope you understand is that when we measure that against the cumulative amount of lost economic activity, that's the bar on the left side of this chart, what you can see is the amount of stimulus far outpaced lost GDP. So multiples higher, over 4 times as much stimulus as lost activity. In some ways, we might say that policymakers overstimulated or went a little bit above and beyond, but I suppose that's better than the alternative of allowing the economy to languish in a deeper, darker, more prolonged economic recession. But as we think about this unevenness with regard to just economic relief, it led to some unevenness with regard to the economic outlook and recovery as well. I think one of the clearest ways to illustrate or articulate the unevenness of the recovery is to examine the difference between consumer spending on goods, which you'll see on the left side of this chart, versus consumer spending on services, which is on the right side. What you'll notice is there was a meaningful acceleration in the amount of goods-related spending relative to the pre-pandemic pace. And if we think about why that was, we just talked about the trillions of dollars of stimulus that were unleashed in the economy, and people, for lack of a better word, were locked inside their homes. They couldn't spend that money on things like going out to eat, taking vacations, going to concerts, and so they bought a lot of stuff. They bought exercise equipment, they bought home office furniture, they bought fire pits and outdoor recreational vehicles. The trouble is, all of that demand came at a very inopportune time because supply chains were really still struggling with the impact of COVID. Here domestically, the availability of labor was difficult. Internationally, where vaccinations aren't as widely available, factories still are being shut down for COVID cases. So a big boom in demand and trouble keeping up with it in terms of supply, well, that's a recipe for higher prices and thereby inflation. If we segment those two consumer categories not by spending, but by inflation, what we can see is it's those areas that have really been the big beneficiaries of demand being pulled forward that have been the epicenter of recent inflation. So it's been relatively narrow and relatively concentrated in consumer goods inflation, particularly durable goods, right? So we think that, ultimately that makes a lot of sense given the amount of demand, but the million-dollar question becomes, where do we see the outlook for inflation going? And really, this needs to be a two-part answer, because on one hand, it's likely that inflation will continue to broaden. So things like a very tight labor market, rising wages are likely to put continued pressure on prices in certain areas. But on the other hand, that's not cause for concern, because we do believe that these very acutely impacted, very narrow industries where we've seen a lot of inflation are not only likely to moderate, but self-correct. So when we put those two factors together, what we're predicting is over time, we're not going to necessarily completely erase the price increases that we've seen for the past couple of years, but the pace of those price increases should continue to moderate. That's a simple kind of high-level view as to what we think is driving inflation. I'm going to turn it over to Charles, though, because, Charles, we're doing a lot of things in the portfolios, explicitly, implicitly, that can help buffer against inflation or uncertainty. So what are the types of things that we're doing, to prepare for this outlook?
Yeah, and inflation's a topic that we think about all the time, not just when it starts to accelerate, but I think this is one area of portfolio construction where the old adage about defense being the best defense being a good offense really bears out. Because when we're talking about inflation protection, we're really talking about getting enough growth into portfolios so that our clients' wealth and spending power can grow in excess of what the inflation rate is. So where do we go for growth? Well, unsurprisingly, the main engine for growth in portfolios is generally the stock market. And what we've seen through this last year and over history is that companies can do very well in inflationary environments. Right now, corporate pricing increases and pricing power is showing strength that we haven't seen in decades. So the good news is high inflation does mean higher input costs, but it doesn't necessarily mean a dent in corporate profits. So stocks are an answer. Adjacent to stocks are also some what we call real assets, real estate in the form of real estate investment trusts or REITs, is an asset we added portfolios broadly in 2020, and was one of the best performing spots of the market last year. Anyone who's tried to buy a house anytime in the last year or two has certainly seen what's happened with availability of new homes. We've seen a similar dynamic in corporate real estate as well. When inflation goes up, it gets difficult to build new supply. Adjacent to that is also infrastructure, things like toll roads, ports, seaports, airports, communication infrastructure. These are relatively economically insulated assets that pay higher than average dividend yields and have some form generally of implicit or explicit inflation pass-through in their cash flows. All of these assets are drivers of what we would consider to be core inflation protection in portfolios. Now, to pivot a little bit to an area we haven't been favoring, if you look at this exhibit, commodities are one of the areas that we think of traditionally as a great inflation hedge because they are very sensitive to inflation picking up. It's almost definitional. If commodity prices are going up, so are input costs, so are prices across the economy. The issue is that you can see commodities are virtually the most volatile asset you can find in the marketplace to put into a portfolio. Also, unlike the other assets we just talked about, they don't generate any cash flows. A steel beam isn't going to cut you a check for a dividend. So you really have to get both the entry and the exit point right. And along with that sensitivity to inflation increasing comes sensitivity to it coming down. So as you talk about inflation moderating, we think that we'd rather stick with these core all-weather cash flow producing assets for inflation protection. And it's worked out well in recent times. But I think as we've talked about the possibility for inflation moderating, that makes me think about the policy picture more. You talked a lot about what happened in Washington. We've been fixated more on what's coming out of the Federal Reserve. There's that old saying that economic expansions don't die of old age, they're murdered by the Fed. Is that what we're going to see this year?
Well, Charles, that's a fun saying, and there's actually some truth to that. But one of the things that I'm really struck by during this cycle is that we're even discussing old age, right? This economic recovery is still in its infancy. If we compare the current recovery to the period of time coming out of the great financial crisis, we're less than 2 years from the end of the COVID recession. So it's a bit unusual that we're talking about things like full employment or Fed policy tightening so quickly. And I think there's a couple of things that are driving that. So first, I'll take it back to the stimulus argument, right? This has been the quickest, swiftest, most impressive recovery we've seen in history. And a lot of that has to do with those trillions of dollars that were aimed at supporting economic growth. The second, though, is that once we're even removing that stimulus from the picture, we still think the underlying fundamentals are overall pretty supportive, right? The economy's on fairly firm footing. Consumers are in fairly decent shape. There are some secular tailwinds for the manufacturing sector. The labor market is very, very healthy. So the economy is standing on its own 2 feet once again. And I think that's why you're seeing this big transition in communication from policymakers. Basically, everyone's acknowledging that the economy no longer needs the extraordinary support that it's received for the past couple of years. So in terms of Washington, D.C., very unlikely that we're going to see another meaningful consumer-focused spending package. No more checks, no more extended unemployment benefits. We are still bandying about the possibility of an infrastructure bill, though every day that goes by, I think the likelihood of that being passed is going down and down, especially in its current form. The Fed has a very similar transition in thinking. We've seen the Fed begin purchasing or tapering asset purchases. They're now discussing the possibility that the balance sheet begins shrinking, and it's current consensus that the Fed's likely to raise interest rates for the first time this upcoming meeting in March. So kind of big, abrupt, somewhat transition from policymakers, and I think this is probably the question of 2022, is just as we transition from an economy and a market that were so supported by fiscal and monetary stimulus, what happens when we begin withdrawing all that stimulus? And the question on everyone's mind is, are we likely to see additional volatility? So what's your view in terms of the likelihood we start to see additional volatility due to this policy transition?
Yeah, it's certainly been a January that's reminded us that volatility is a normal part of business and investing. And I think anytime you see significant volatility in markets, it's a good time to take a step back and really survey the landscape as it pertains to the economy. Because to oversimplify things a little bit, if you go back in the history of the market, you can break down these volatility periods into two basic baskets. Those that come along with a recession and those that come without it. Recessionary pullbacks generally turn into bear markets. The average pullback when you have a recession is over 30%. Without a recession, it's still normal to have volatility. 10% pullback is usual in any given 12-month period. But the average drawdown's only about 15%. Importantly, the period of time it takes to bounce back is a lot shorter. These non-recessionary drawdowns, you get about a 6-month average time to recover. It's closer to 2 years when you have a recession. So I think hearing everything that you're seeing on the economic side really helps inform what we should expect. We may well see additional volatility this year, as we did in January, but we think that as long as the economy remains on stable footing, that's probably an opportunity for us to pick up some deals as we see some of that shakiness in the market. We'd still see leading economic indicators very strong, some steepness to the yield curve. So that's the environment we're in now. Now, you mentioned the transition. If Fed policy starts to put pressure on the economy, we start to see things slow down, maybe we start to worry about future drawdowns being more in the other camp. But for now, we're optimistic that we can find some deals with volatility. Now, the big question we get from clients most often when we say we're looking to be opportunistic in this market is that wise given how expensive things are? And I think there's some fairness in that question, because if you look at PE multiples, price to earnings multiples, how much you have to pay for $1 of earnings from the S&P 500, there's no denying the market's expensive. This chart shows the forward PE multiple for the market going back the last 10 or so years. And you can see we're currently at elevated levels, about 1 standard deviation over the average for the last 5 years, but more elevated than that in a historical lens. There's good news and there's bad news here. The bad news is that an expensive market means that earnings growth is going to have to carry the load for future gains. The good news is that this is not a good timing tool. You can see we've been at this elevated level for a number of years. An investor looking at this data and the expensiveness of the market at the beginning of last year and saying, I'm going to sit this one out, would have missed out on a 29% year in the S&P 500. So that growth we saw last year, the question implicit in this expensiveness is the market running away from reality? We can break down market returns into what we're seeing from actual growth in earnings and what we're seeing in this price to earnings expensiveness ratio. Last year, earnings contributed more to the growth in market return than at any time in the last 30 years. It was an outrageously good year for earnings growth. And so we actually saw this metric get a little bit more cheap by comparison. The other piece of good news on this is that not all stocks trade the same. And we've seen a big spread develop over the last 10 years, and even more so over the last 2 years, between what we'd call growth assets and value assets in the market. This chart shows the PE ratio of the Russell 1000 Growth, a large US company index that's focused on companies that have above average growth expectations. Think more technology, internet retail, communication services, things like that. That segment of the market has been favored by investors for the last decade, and it's normal for those companies to be more expensive than their value counterparts. You can think of value as more traditional areas of the economy, industrials, financials, more heavily weighted towards those sectors. Now, all things equal, you want a company that has faster earnings growth, but all things aren't equal. The amount of dollars you have to pay for $1 of earnings from the growth segment of the market was wide going into COVID, and coming out of it widened even further. And you can see now we're at the widest points we've really been since we've been tracking this data. That creates some unique risks. We've talked for a couple years about how the market's getting more concentrated. At the beginning of this year, if you took the top 10 stocks in the S&P 500, they're about 31% of the overall S&P 500 weight. So a third essentially of your portfolio, if you buy an index, is just those 10 stocks. That's unique. It's been getting more concentrated over the years. The last time we were this high, you have to go back to the early 2000s, March of 2000. Now, it's good for the indexes that it keeps happening because there's some momentum there, and as long as the winners keep winning, the overall market does well. But when that trend reverts, it can signal some problems. Those concentrated assets are more on this growth side of the ledger. If you look at the forward return after the last reversion from a peak in March of 2000, the S&P was down about 20% for the following 12 months. That's the bad news. The good news is that the equal weighted S&P 500 was actually up 5%. So if instead of weighting your allocations by the size of the companies, you just put an equal allocation in every company in the index, that had a positive return in that down market. And over the 5 years following the reversion, the gap in performance was about 60%. So we think that there's ample opportunity to control risk by being selective in where we're buying, the types of stocks we're buying. We think there's a place for some of those growth companies in portfolios, but we certainly want to manage our allocation and diversification in a way that takes some of the edge off that valuation risk in the market. So to control risk, we can certainly focus on the right type of quality securities. You certainly saw just this January that bared fruit. If we just updated the chart to show what happened to these relative price to earnings ratios in January, and most of the pain was on that growth and technology sector. So some of the pain we could feel on interest rates could push that. We think it's a good time to be very focused on that. But asset allocation is always a critical part of what happens with risk with the market and the economy. And I think some people, and a common question would be, you just said the Fed's going to raise interest rates. Why on earth would I want to own bonds? We think there's still a place for that in a lot of portfolios.
Yeah, if you've been tuning into these for the past few years, I'm going to sound like a broken record because, bonds are never meant to be return-seeking assets. We view fixed income more as a risk mitigation stabilizer for the return-seeking assets like equities and other things in your portfolio. The good news is, though, if the near-term outlook does have you nervous, there's a lot of cushion baked into current levels of interest rates. So right now, about 5 or a little more than 5 interest rate hikes are priced into the market, and that's very much toward the upward end of our expectations of what the Fed will be able to do during a transition year and also allowing its balance sheet to contract. So kind of a structural reason to own bonds and a cyclical insurance policy against kind of near-term interest rate fluctuations. But I think to kind of conclude or to tie a bow on things, economically, things are still on relatively firm footing. We do expect that a lot of those areas that have had acute price pressure begin to moderate. Still not worried about overall levels of growth. Again, very healthy, but likely to be a big transition year for policymakers, both from the monetary as well as fiscal side of things. Charles, any closing remarks on the market?
Well, I think with those transition periods, we really are focused on balance and sort of threading the needle here with portfolios now. We want enough growth and kind of all-weather inflation protection through some of those assets I mentioned earlier with growing cash flows to protect real spending power in portfolios. But we're very focused about risks that come with market concentration and heightened PE multiples, as well as the need to have some safe assets in portfolios for unexpected shocks like the recession we experienced in 2020. So this is why our customized and personalized approach is important, and why all of our portfolio managers are really focused on individual client situations when putting together portfolios. So with that, Brandon and I would like to thank you for your time and attention, and now we have a short video for you to enjoy about our culture while we reset the stage for our next panel. Thank you.
How do you boil down simply the essence of the firm? What it is we're here to do, and that is to provide financial peace of mind to our clients through trusted counsel, exemplary service, and a genuine heart to serve.
Success at Johnson isn't defined by a sales goal or a number. Our success is defined by how happy our clients are and how well cared for they feel.
We are really focused on improving the quality of people's lives.
We're right alongside as counselors, as friends, just a trusted advisor.
We put Counsel in our firm's name early on to know that this is beyond just the financial picture. This is about life, about life's events, and how to live a fulfilling and successful life.
The most important thing we do at this firm is hire people. There's nothing more important. We're hiring people that are really dedicated, and the dedication has to come from serving others. That's key to our success.
We can teach everything else. If they come here with a mindset of integrity, service to others, and are comfortable in a culture of a team-based environment, they'll be successful at Johnson.
We take very seriously the people and the structure that we put around our client families. That is something that our clients feel it immediately. When you get that bond together, it's special.
We really live out the value that is if an employee feels like the quality of their life is balanced and healthy and whole at work. I think service freely flows from that, and our clients very much experience that.
You know, the assets of this company are the employees. It's the only asset we really have of value. And we take a lot of time in hiring people. It's the critical task.
We've tended to hire people at an entry-level position and grow them from within. We believe we can instill the culture that way and really have them understand the business over time, how we serve clients in the Johnson way.
I started at the very bottom rung of this firm and have worked very hard and very diligently and have been given opportunities along the way. And honestly, as I look at what my role is today, it's to provide the exact same opportunities to others that were given to me.
From the moment I arrived at Johnson, my supervisor saw my potential and basically paved the path for me to reach it.
I have experienced the other top value of Johnson's, which is requiring the highest level of integrity, honesty, and morality. We very much treat our clients that way in the advice we give, but more importantly to me as a female professional in particular, this is the first workplace where I have truly experienced being treated according to those values.
Everybody is here to make a living in a certain way, and I think that that's an important part of the culture.
You know, something that's very special and unique about Tim, and unique in this industry, is this business was never about him. I know that because I've lived it. I've been here for over 20 years now, and so I've seen that progression from Tim and then handing over to us as employees, empowering us to make decisions to take this to the next level, which is exactly what we've done and continue to do.
We want to continue to grow. We want to maintain the kind of culture that we've had for a long time in serving people. It's the only reason we're in business. We don't want an outside influence sharing their thoughts or their philosophies of how to do this. We want to remain independent and serve people for generations to come.
Good afternoon. I hope you enjoyed our video and learning a little bit about our Johnson culture. My name is Michael Barnes, and I'm president of Johnson Trust Company. I'm also the president of the Johnson Charitable Gift Fund, a public charity that provides donor advised accounts and endowment funds for our clients and donors. I've been a Johnson employee for 23 years and worked directly with our clients in developing great estate plans and charitable gift plans. You know, the most important part of a great financial plan is implementation. The best plans are worthless if the plans aren't carried out flawlessly and with precision. Successful plans require correct titling of assets and beneficiary designations and alignment of the estate plan documents with the client's well thought out concerns and goals. Details matter. Johnson Trust Company implements trusts with over $2.5 billion in assets. Our trust team implements our clients' estate plans with the same care and concern we would provide to our own families. We hire team members who are passionate for details and for our clients. We pay attention not only to the terms of the trust agreement, but also to the purposes and goals our clients tell us for the use of their wealth by future generations, and to the tax and asset protection results our clients are seeking when they develop their estate plans. These are very important plans, and we know our clients are counting on us to implement the plans successfully. But to get to a well thought out plan, you need to, well, think about it. Another important service Johnson Trust Company provides our clients is assisting them in developing their estate plans to align with their goals and address their concerns for their family. Many clients are concerned with the impact wealth they leave to their family will have on their children and grandchildren's initiative, values, and relationships. Our attorneys and trust administration staff at Johnson Trust Company are very comfortable talking about these topics, asking good questions, and sharing examples of how we've seen other clients craft successful plans. Trust can be very effective at establishing a family philosophy for the appropriate uses of wealth by future generations, implemented by Johnson Trust Company serving as a well-informed trustee or co-trustee with family members. While thinking about their estate plans, some clients are also worried about the income and estate taxes that will come to bear on their wealth as their important estate plans are implemented. The attorneys and trust team at Johnson Trust Company are very familiar with the tax saving and asset protection strategies that trusts can implement, from the simplest and most practical strategies to the complex and most detailed strategies. While helping our clients in developing and implementing their estate plans, we also know the important role our client's attorney should play on the planning team and in drafting the documents we're going to use to implement their plans. We've worked with attorneys all over the United States and have learned ideas and strategies from the best. We believe our focus on helping our clients to clarify their goals and educating them on the planning and tax savings options allows them to get the maximum value from their attorney's advice and counsel. Finally, I'd like to emphasize the importance of the Johnson Charitable Gift Fund in implementing our clients' charitable gift plans that often involve family and make incredible impacts on our community. The Johnson Charitable Gift Fund holds over $244 million in charitable assets in donor-advised accounts and endowment funds. Last fiscal year, the gift fund distributed $49.5 million in grants to charities directed primarily by our clients. Wow! Directing that amount of charitable capital takes more than just writing a check. It takes careful thought and real love and concern for others in our community. To our clients who are donors to the Johnson Charitable Gift Fund, I want to say thank you for using the gift fund to make such an extraordinary impact on our world. The second half of our presentation today will demonstrate how we work with clients to develop and implement great financial plans and our best thinking on planning issues you should be considering for 2022. To lead us through our panel discussion, I'm pleased to introduce you to my friend and colleague, Scott Wyckoff. Scott is a managing director and works in our family office division. He has worked at Johnson Investment Counsel for over 14 years and has earned the Chartered Financial Analyst and Certified Financial Planner designations. Thank you.
Thanks, Michael, and welcome to the last segment of our Wealth Management Forum today. I'm joined by three of my colleagues. My name is Scott Wyckoff, and we're going to talk to you about different financial and wealth management strategies as well as estate planning strategies today. But first I'm going to introduce each of my panelists and we'll get started right after that. So immediately on my left is Tony Cure. Tony's a portfolio manager in our wealth management division. Tony's a certified financial planner and also heads up our wealth planning committee. And next to Tony is Laura Mattern. Laura is a portfolio manager also in our wealth management services division. Laura holds the Chartered Financial Analyst designation and is also a certified financial planner. And on my far left is Mary Burns. Mary's an attorney in our Johnson Trust Company. She's also vice president of estate planning and senior trust counsel. So let's dive right in. Tony, I'll start with you. Charles and Brandon just gave us a lot to think about in terms of the economy and the markets. So could you provide an overview of, in light of all that information, how we're managing portfolios for clients?
Sure. We did hear quite a bit about portfolio construction and economic data, a lot of charts and graphs, which are certainly valuable and a lot to digest, as you said. But really, we view our role as an intermediary or a translator, building that bridge from these sometimes complicated, sometimes abstract concepts to actionable items that have to get implemented in a portfolio. And when a portfolio we view as just the engine or really its job, what is its real job? We have to take a step back and try to determine what is the job of a portfolio, and what that means is what are its goals. And to do that, we need to have conversations with folks. We need to talk, and we need to spend time. It can't be checking a box of an asset allocation and letting it set it and forget it. It's much more than that, because it also needs to be integrated with tax policy, as we're going to talk about, estate planning, which we're going to talk about. So when we put these all together, we need to talk about risk appetite and risk capacity, and not only asset allocation, but what is the right asset allocation for a certain set of circumstances? Specifically, what are the spending needs? What's the income that's coming in? All that requires a big recipe, for lack of a better term, that needs to be taken into account. And we're fortunate that we have the benefit of an institutional class research team that is obviously very well informed and keeps us well informed. Best of breed technology helps as well to make sure that when we're talking with clients, having these conversations, that we're making the most informed decisions side by side with our clients.
Okay. So Laura, could you expand on that, what Tony said, and talk a little bit about how we incorporate all that information when we're looking at clients' financial plans, specifically as we're talking to them about cash flow, particularly for those who are approaching retirement or already in retirement?
Yes, so when we advise clients on cash flow through retirement, we are modeling adverse market conditions and inflation to develop a safe range of spending that is sustainable through all the years of retirement. And Tony alluded to this, and so did Charles. We are going to look to keep 3 to 5 years of living expenses outside of the equity market and in safe assets like fixed income. And this allows us to take a long-term approach to the portfolio and resist the urge to react to short-term events that might occur or market volatility, which can often cause more damage in the long run than good.
Yep, okay. Tony, last year in this forum and all throughout the year, there was a lot of talk about potential overhauls to income tax policy. So could you provide us with just a brief overview of what was in play, what was discussed, and ultimately what played out?
Sure, a year ago that was a big topic where we were detailing all these different changes that were proposed and probably had a pretty solid chance, we thought, of being implemented. Some of those included really targeting higher earners from a higher tax rate perspective and also a higher bracket perspective, changes to how Roth accounts are handled. There was some proposed changes on capital gains taxation and even some changes with respect to state and local taxes, how deductible they could be. So all these things were all on the drawing board, but as the political winds tend to blow, nothing ended up happening.
Gotcha. And Mary, similarly on the estate planning front, there were a lot of policies, changes to those policies in discussion, but could you provide a similar overview to what Tony just gave us on the estate planning side?
Sure. Around the end of third quarter, beginning of fourth quarter, the legislation that came out that proposed so many changes, one of the major changes that was anticipated, and our clients did some planning around this because we thought that there was going to be some traction and that the law might pass that had come out of the House Ways and Means Committee, was to cut the exclusion amount that each person has with respect to federal estate tax. So last year, each person could pass $11.7 million without incurring any federal estate tax, and the proposed legislation was going to cut that about in half. We did some planning, we did some good planning. It was good for a lot of other reasons, but as it turns out, that legislation just didn't end up going through.
Okay. So on both fronts, a lot of things fell by the wayside. Laura, could you provide just a brief update on a few things that maybe did change?
Yes. So the IRS issued new life expectancy tables, which are used to calculate required minimum distributions, or RMDs, from retirement plans. And the new tables reflect a longer life expectancy as people are living longer. And RMDs calculated using the new tables are lower than in prior years. So this will help retirees keep more money in their retirement plans and have lower tax bills. And then another change was due to inflation. IRS adjusts tax brackets every year, and the tax brackets were boosted extra due to the inflation. So bracket breakpoints rose by about 3%, and tax rates, of course, remain the same. The IRS, however, does not adjust all limits and deductions and exemptions for inflation. For instance, the profit exemption on the sale of a home hasn't been adjusted since 1997, and the Social Security deductibility threshold hasn't been adjusted since 1994. So as asset prices increase and wages increase and these deductions and exemptions remain the same, it's sort of a subtle tax increase for people that they'll experience. Yeah.
Right. Okay, Mary, so no major changes on the estate tax front, but any smaller or more particular updates that we should know about?
Yeah, again, we're back to inflation. So that $11.7 million that I alluded to before that a person could pass free of estate tax went up this year for inflation. So currently in 2022, if someone dies, then they can pass $12.06 million at death without incurring federal estate tax. And that's also the gift tax exemption for transfers during life. Additionally, the annual exclusion amount went up. That's the exclusion amount that each person can give to somebody without whittling away at that lifetime or death exclusion amount. I'll say here too, a change that is still coming. It's not this year, but as the law is currently written, the amount that went up again this year to $12.06 million as an exclusion amount is scheduled to go back down starting in 2026. So if someone died in 2026, that exclusion amount from the federal estate tax would be actually closer to $6 million. So that is still coming, but not for a few years as it stands right now.
Okay, great. Okay, so we've looked back. So let's start to think of this year and beyond. Tony, before we get into any particular strategies or policy updates, could you provide some context about how do we process all of this at Johnson as we're working with clients, as we're looking at their plans? What are the bedrock fundamental thoughts we're having as we approach this?
Yeah, I think it's important to provide perspective and sort of take a step back. We tend to very much focus on what's right in front of us and get into the weeds of tax policy or valuations and market dynamics. But historically, if folks would really take a bigger picture, that's what we try to provide, is a bigger picture perspective. And look, how have markets performed over the long term, which is our investment horizon mostly. We'll find that folks that tend to focus on trying to call a particular tax policy or call a particular market move often don't end up doing a good job because it's psychological. It tends to hurt more than help. So when we think about the political winds blowing, we also have to remind folks not to underestimate the power of our economic system, of our technology, of our innovations, of entrepreneurship, of our contract law that's in place in our country, and even the checks and balances within our political systems. You know, we're talking a lot about politics quite a bit, but there is an inherent checks and balances, which over time tends to steady the ship and provides us an opportunity to really take a step back and focus on the longer term picture in a multi-decade type investment horizon, not just this year or 6 months from now.
Right. So we're going to stress the word potential today a lot. So given that backdrop, what are the potential income tax changes that might be coming down the pike this year?
Right. I just said to take the big picture, but let's talk about near term. No,
Yep.
because there is always that part of our job is to make sure that folks, that we have our eyes on what's going on in Washington, because it can be impactful, but again, not to try to predict or make calls on it. So we view it, because these things tend to happen quickly. In other words, the Secure Act was passed December 19th, I think, of 2019, giving folks 12 days to change the tax policy, a lot of retirement changes, things. So these can come out of left field, so we have to be vigilant and keep our eyes on tax policy. That being said, as Brandon alluded to, we're not going to probably see another stimulus package given what's going on economically. Wouldn't be surprised to see something happen with respect to some tax policy, maybe some tweaks. We're not looking for a major overhaul of the tax policy that was proposed sitting here a year ago.
Okay. So Laura, could you provide some detail on, Tony mentioned, maybe some smaller pieces of legislation, maybe some changes we have our eyes on this year?
Yes, so the Secure Act 2.0 is a bill that passed the House Ways and Means Committee last year, and looks like it's gaining traction and could potentially be passed this year. The bill is designed to increase retirement plan savings and participation, with the idea that people are living longer, needing to save more and work longer to do that. So a couple key pieces of the bill as it stands right now include increasing the catch-up contribution amount that participants over age 62 can contribute to retirement plans, and then sort of stair-stepping the RMD age from 72 to 73 in 2022, 74 in 2029, and then finally up to 75 in the year 2032, so over the next 10 years. So we think that there's some possibility that this bill could be combined with a lighter infrastructure Build Back Better bill and could be passed later this year.
Okay. And those retirement catch-up contributions, that is available at age 50? Did you say 50 or 62?
It's 62 for the 10,000 amount in the bill currently.
Gotcha. Okay. Interesting. Okay, Mary, back over to you. Any big changes on the table on the estate planning front this year?
Not that we really know about. I don't anticipate many. It's a midterm election year, and all the people who run for president for office talk about big changes to the estate tax laws, but that just really historically hasn't typically played out. I think that in the midterm election, there's a lot of other things that I think the legislators are going to be more focused on. In the end, the estate tax. The revenue generated by the estate tax is such a tiny portion. It's less than 1% of the federal revenue, and it affects far fewer than about 10,000 people a year who actually pay federal estate tax. So it doesn't affect that many people, and it doesn't affect the revenue of the country in a huge respect. So that being said, Tony said things can come out of left field, and that could always happen, I suppose.
That's right. Always possible. So. Tony, given just the general landscape and things we always think about, and also what you mentioned about potential changes to policy, what are some of the planning strategies that you're discussing with clients this year and that all of us at Johnson are thinking about for clients?
Sure. Now, the landscape for as it exists today still does provide some opportunity from a planning perspective. There are some timeless strategies that really can be effective, and there's a sweet spot that I call the golden window of tax planning, and what that is, I wrote about this in our blog. It's on our website if anybody wants to read about it. But essentially, it's that sweet spot of folks who retire early and no longer have wage income, but they're not taking Social Security, not taking required minimum distributions yet. So there's this time frame of years potentially of low income. We view that opportunistically from a planning perspective to not only save on taxes in a particular year, potentially save on taxes for multi-decades and maybe even multi-generations. And of course what I'm talking about is strategically doing Roth conversions and Roth contributions and things like that to have that diversified tax base from a retirement scenario. But we do that with mindset of where we are in the tax brackets to make sure we're not paying too punitive a tax rate on these converted dollars, for instance. Low capital gains rates also can mean, with low income, an opportunity to revitalize the portfolio without incurring too many capital gains. So maybe if we had our stock portfolio run and we're hesitant to get out of those positions because we don't want to pay the high capital gains rates, well, we could be on the thresholds of paying 0 or 15% tax to exit those positions and right-size the portfolio. So that golden window is an opportunity to get creative, and it's actually kind of fun to work those numbers every year.
Lots of fun. Okay. Laura, any other strategies that you want to share today?
Yeah, some typical year-end tax planning strategies to employ would be donating appreciated stock, bunching or grouping charitable gifts from future years into the current year and taking itemizing your taxes instead of doing the standard deduction. If you're still working, make sure you're contributing to your employer retirement plan and your health savings plan. Make sure you're maximizing contributions to those plans. And then also make sure you're contributing to your IRA or Roth IRA if you're able.
All right, great. Okay, Mary, what are you and others in Johnson Trust Company discussing with clients these days?
Well, we've talked a lot about taxes today, so just to finish that up, I do think that given the changes that we have coming, that are the way the law is currently written, like I said, the exclusion amount is going to go by about half. If someone is planning on using their lifetime exclusion amount, lifetime or death exclusion amount of currently $12.06 million, I would encourage using that sooner rather than later. When you move assets out of your estate, whether that's into a trust or just into somebody else's hands, you're also moving the growth of those assets out of your taxable estate. So doing it sooner rather than later has great benefit. I think also that if there are annual exclusion gifts that people want to make, go ahead and make those as early in the year as you can to make sure those get completed. And then I think what is always, or what has been true for quite some time, is that gifts made on behalf of someone, if you want to pay for someone's education, payments made directly to the educational institution do not count against annual exclusions, do not count against the lifetime and estate tax exclusion amounts. So those are also medical care. So again, paying a provider directly is a great way to get those assets and growth that would come from those assets out of your estate, and to benefit people while you're alive, which is fun. So we have talked quite a bit about taxes today, but as everybody here has probably heard me say in a meeting, I don't like the tax tail to wag the dog. Ultimately, what we're all trying to do here when we talk to our clients about estate planning is we're talking about how are they going to take care of the people who matter to them, whether that is their family, friends, or people who ultimately benefit from charitable organizations that might receive the wealth that someone passes on to them. And I use wealth in big amounts and small amounts. All of those are any amount is what we're trying to work with, and to make sure that our clients' estate plans are where they want to be. We're keeping the taxes in mind. It's interesting to us to talk about, but ultimately we're trying to do what the clients want to do. So I think we do that whatever year it is.
Great. Awesome. Well, thanks to each of you for your expertise and for sharing those thoughts. We covered a lot of ground in a short amount of time, and so we always like to remind people that your specific circumstances matter, and it's important to take those into account when you're working with us, when you're working with other advisors, because there's a lot of intricacy to some of the things we've talked about today. So that's an important aspect of planning that we always discuss. So thank you again for watching, and we want to thank our clients for your support over the years and your loyalty to our firm. We sincerely appreciate you, and we also appreciate you sharing with family and friends who may benefit from a conversation with us, sending them our way. We're, of course, happy to discuss any of these topics or any other financial questions with anyone in your life. And a recording of this forum will be available on our website on the Perspective tab. There's also a lot of other content. Tony mentioned the blog that's out there. There's a lot of content there that you may find helpful, so check that out. So thank you again for watching, and we want to wish you a great evening.